once again to First National Bank's annual Business and Economic Forum. As the MC said earlier, it is the fourth time we are hosting this event, which brings together business executives, policy makers, and some of the smartest brains in our institutions of higher learning to discuss and brainstorm investment trends in Africa. It's based on the report which was generated by Rand Merchant Bank, Where to Invest in Africa. And Rand Merchant Bank is the corporate and investment banking arm of the First Rand Group, of which we are a 100% subsidiary. I'm delighted that once again we have Celeste Falconer and Neville Mandemika, who are the co-authors of the 2019 report, and they have spent a lot of time analyzing the trends in Africa, and in particular, the impact that they may have on Ghana as well. First National Bank is a bank which understands businesses, and we are as interested in your growth as you are. I mean, after all, we consider ourselves as your business partners. So we are therefore hopeful that the deliberations today will give you a better insight into Ghana's key economic performance metrics to help you make more informed decisions which will enhance your business. We all know how challenging the last few months have been, or years actually, have been with regard to the banking industry. The enforcement of the new minimum capital requirement of 400 million has changed the banking landscape quite considerably in recent times. At First National Bank, we were able to meet the minimum capital requirement thanks to a fresh injection of capital by our parent company. And I think we can all take that as a sign of confidence in the Ghana economy and indeed in First National Bank Ghana as well. The past few weeks have also seen a lot of turbulence in the foreign exchange markets, where the cedi initially lost considerable ground against the US dollar before thankfully recovering quite considerably in recent times. And I'm sure that Celeste and Neville will shed some more light on that as well. So while we are delighted with the recent recovery in the cedi and hope that it continues, hope is not enough. For most outsiders looking in and observing recent developments in Ghana, these are uncertain times which demand investor caution. But for us at First National Bank, we see this as an opportunity. This uncertainty always produces opportunities for growth and an opportunity for us to demonstrate our resilience. So in these times of uncertainty, we ask you, how can we help you? As Africa's most innovative bank, we will continue to innovate and provide clients with the needed digital banking solutions that will make your lives easier, better, and more productive. The Breakfast Forum is just one of the many avenues which we want to use to make our presence felt in Ghana. I'm hopeful that the discussions we have today and the ideas generated will help boost Ghana's reputation as one of the best investment destinations of the continent. Finally, I'm delighted to see that we have so many customers of our bank here, as well as from other banks as well, and hopefully next year I'll be able to welcome you as customers of First National. So once again, honored guests, ladies and gentlemen, welcome to First National Bank's Economic and Business Breakfast Forum for 2019. Thank you.
Can we do a better round of applause for Mr. Hudson? Went straight to the point, recounting recent history and the hopes of the future, and setting the tone properly for a very interesting conversation. Ahead of the conversation, we'll have a presentation by the co-authors of the report. Celeste Falconer is making a return, and it's a pleasure to have you back. And as we progress, she didn't come alone, she came with the co-author, Neville Mandemika. Ladies and gentlemen, let's welcome them as they give us the presentation.
Good morning, ladies and gentlemen. I firstly want to thank First National Bank of Ghana for having me every year. It's always nice to come to one of my favorite countries in Africa. I'm not just saying that because I'm here. And then I brought Neville to make us look even better, and the handsome man on my right. He's only got 2 slides to do. I'm doing the rest. But I think he's doing one of the more difficult slides of the capital markets in Ghana. But without further ado, I would like to go straight into the presentation because, obviously, time permitting, I want to highlight what the key findings is of our flagship document called Where to Invest in Africa. It's now in its 8th edition, and we're almost heading to the 10-year anniversary. And then also dig a little bit deeper into the theme that we have in the document this year, which I'll discuss now. And then, of course, just end off with where we are seeing Africa, or Ghana rather, representing itself in Africa and how it's been doing over the past few years, but mostly with the focus on how we are going to do in the next 5 years. Going straight into the document, which is available on our website, we look at specifically the economic side of African economies, and we look at the business environment. Now, specifically, looking at the overview of the document, we look at who's the best ranked economies in Africa according to their attractiveness. So that's called according to a certain methodology that we use, and highlighting specifically economic outlook, so the growth over the next few years, GDP growth, also the market size of each of these economies, where we know that Egypt, Nigeria, South Africa are your largest markets. And then I think the most important component that we look at is your operating environment. So how easy is it to do business in these economies? For that component, we use different surveys across the world, specifically looking at the World Bank's Doing Business report. We also look at the World Economic Forum's competitiveness report, giving us an indication of where we are seeing improvements in the regulatory environment in most of the African countries. Together, we give 50% weighting to your economic activity scoring and then 50% weighting to your operating environment scoring. It might sound like quite a simple methodology. The reason why we keep it this high level is because there are so many different sectors that are sitting in this room at the moment, looking at different risk appetite, looking at different avenues of investing into our African markets. Within the document, however, we do give different weightings to all of these indicators. So you can literally play around a little bit to see where you benefit the most, whether it's from a risk-off perspective, a risk-on perspective, or if you want to see where the biggest growing markets are going to be one day. Essentially, the rankings that I'm going to show you now is this 50% economic activity scoring and the 50% of your operating environment. So who are the winners in this year's publication? Egypt, for the second time in the 8 years that we've been writing this document, has made the #1 spot. It's overtaken South Africa as the most attractive investment environment, much to the dismay of us South Africans and our media. But there's reason for this. If we go back and look at the methodology that I've just explained, Egypt's growth rates are much higher at the moment and forecasted for the next few years. Where South Africa is only going to grow about 1 to 2% over the next 3 years, Egypt is growing by 4 to 5%. And of course, Egypt is now the largest market in Africa, above Nigeria, if we look at it in purchasing power terms. South Africa is still one of the best business environments. So if we had to look at it from a risk component, South Africa will still be #1. We are still the largest markets, capital market and portfolio or equity markets, and we're the most liquid. So there's reason why we are still #2 as the most attractive investment destination. I don't want to go through all of these countries because that can take me all 30 minutes that I have to speak. But I just want to highlight that the countries that are often, or almost all the time in the top 10 are your East African stalwarts like Kenya, Tanzania, and Ethiopia. And then from a West Africa perspective, we see Ghana and Nigeria, and also Cote d'Ivoire coming into the top 10. And then from a North African perspective, we always see Egypt and Morocco in your top 5. Highlighting Ghana, if you did read the previous year's document, unfortunately Ghana has slipped down the rankings. Where Ghana was #5 in last year's document, it is now #9. But I think we would rather leave that discussion for when we have the panel and where we will answer those questions. But in short, it is the fiscal indiscipline that we've seen in Ghana over the past few years that is now showing a delayed reflection in some of the surveys. So we can see there's still that investor concern of what is going to happen from a fiscal health perspective in Ghana over the next few years. That's the main reason. And we can also discuss all the other countries after the breakfast presentation. The main focus is who's the next top 10. So we can see other countries that you might have asked, where's Mauritius? Where's the Botswana, for instance? Very easy business environments. Why aren't they in the top 10? But we always say they're still very small markets, and these markets only have about 4 million people altogether in Mauritius, in Botswana, in Namibia. Also, these markets are only growing by about 2 to 3% over the next few years, so very similar to the rest of Southern Africa, we are feeling the pain. The consumer is not doing very well. The extractive industries are also not doing that well because of slower than expected commodity prices. Then from a Southern African perspective, we also see one of our countries, Zambia, in the form. Zambia is also a country that is currently battling with also its own fiscal indiscipline. And then another country that has come back into the top 20, a very interesting one, is Angola. Angola, the reason why it's moved back into the top 20 is higher oil prices, and we've seen a significant change in the political stability of the country over the past 2 years. So ladies and gentlemen, that is the crux of the Where to Invest in Africa document. So you can see now who the top 20 most attractive destinations are in Africa. And of course, we can also use the panel discussion to argue some of these countries that are in the top 20. A very good example, Tanzania being in the top 10 is being questioned quite often by some of our clients because it's a very difficult business environment. And we see that the regulatory environment is being clamped down on. If we look at specifically what is going to happen in Africa from a growth perspective, this is the regional GDP growth profile. Now, we can see that your countries in your emerging and developing Asia are the ones that is going to drive this growth. Yes, we are indeed seeing a country like China experiencing a slight soft landing, but it is still an economy that invests heavily into Africa, and we do not expect that to change anytime soon. But the question is, over the long term, where is Africa sitting? So we're still above most other regions in the world, and we're above world growth. But I do not think that we are going to experience that 6 to 7% growth rates that we saw a few years back in the future. I think it will be around a 3 to 4%. The biggest reason for this is that we are still battling with rising debt levels. Us in the country of Ghana, we understand that experience, and we also see weak credit growth, where it used to be quite strong over the past few years. We are seeing that developing again, but it's going to be at too slow a pace. But the prospects are still strong. So we still have resources. Even though it could be the crux of African economies, we still have it. And I believe that in the next few years, agriculture is going to be one of the biggest drivers of your resources sectors in Africa. We still have strong demographics. We still need countries to take advantage of this. We are seeing improved business environments. It's only in certain pockets across the continent, and the document does highlight which countries those are. And of course, we are seeing the potential of more revenue collection. Even though this is a big risk, it should be both in the risk and the prospect section. But revenue collection is still so low in Africa. Just a few simple changes that governments make can improve this revenue collection. And one of the areas that is an easy way to do this is bringing your informal sector into the formal sector. Governments need to get strong initiatives for these informal and entrepreneurs to come and enter the formal sector, whether it's lower taxes or just ease of getting their goods from point A to point B. Many aspects governments can tackle. Then specifically looking at the most problematic factors of doing business in Africa. It is liquidity, so access to financing, and it's infrastructure. And this leads me exactly to the theme that we are focusing on this year in this document, is infrastructure. The 2018 document looked at access to financing. So if you want to go back to those documents, we focus on the currency risk in most of these economies, where the liquidity is coming from, what are the largest export revenue earners for each country in Africa. This year we focus on infrastructure. We have seen a significant deficit over the past few years, and that deficit is just growing. So briefly, and I do understand that the text on this slide might be quite small, and for those in the back not seeing it, But it's just to highlight that the infrastructure needs in Africa has now changed from that $90 billion deficit annually to about $130 to $170 billion now annually. That's the changes we've seen in the latest Africa Development Bank report. And it's nothing new. We all know the problems. It's electricity, water, technology, and the actual hard infrastructure of road networks, railway, ports. And this year's document focuses exactly on that. Where does the deficit lie in each of these countries? And with that deficit, we highlight that this is the major opportunity for you as investors to go into these markets. If we look specifically at which countries have the best quality infrastructure, and again I will highlight because the text is so small, this is an index by the African Development Bank looking at all types of quality of all infrastructure in Africa. It's roads, railway. It also looks at your water and sanitation. It also looks at electricity. And then lastly, at your health and your education. So your more soft infrastructure. And the winners here are countries like the island economies, Seychelles. Seychelles has the best quality infrastructure in Africa. And the reason for this, and that most island economies have good infrastructure, is because they want to attract tourists. They want to get those tourists safely from point A to point B. And of course, they've got some of the best ICT, or information and communication technology, in Africa. It's because they want their tourists to be able to connect to the outside world in an easy manner. We also see that countries in North Africa and Southern Africa are also at the top of the infrastructure rankings. It is because we are, South Africa specifically, one of your more developed economies. Egypt also. Egypt, in fact, has been ranked better infrastructure than South Africa. And a very good example here of a country that can ruin its infrastructure is Libya. This is the 2018 index for Libya. So we can see Libya is actually third best infrastructure quality in Africa. But now what we've seen with the political turmoil, the civil war, it's actually been breaking down that infrastructure. So in the next year's survey, Libya will definitely not be in the top 10. Ladies and gentlemen, Ghana is still there. They're in the top 15 of best infrastructure quality in Africa, but there's still a lot to do in the country. Most of West Africa is investing below 3% of overall government GDP into infrastructure. And we have learned that you need about 6% to 7% investment of your GDP into infrastructure to at least have growth rates above a 3% annually in Africa. So there's a significant need still in the market. Before I end off with looking at the Where to Invest in Africa document and go more into what's happening in the Ghanaian economy, we look at financing of infrastructure. Now, this is the opportunity and the deficit that I've highlighted earlier. At the moment, it is the governments that are investing the most into infrastructure development in Africa. But this is the problem. As I've mentioned earlier, most of these governments only invest 3% of overall GDP into this development. So it's something that needs to change drastically. In fact, you can see by the following slide that the Africa's infrastructure funding sectoral split is quite broad. Compare left-hand side to the right-hand side. On the left, that is your government investment into infrastructure. We can see that goes predominantly into your harder infrastructure, like your electricity, and then your your transport and your energy and utilities, which is understandable. The government needs to win votes, so you still need to invest in aspects that will get the economy going and that also can get your people from point A to point B. If we look at the right-hand side, private funding, which is only 10% of overall funding into African infrastructure, these companies focus mostly on construction. And why is the reason for this? Is because construction is your easier and short-term investment or infrastructure investment projects than what we see in your electricity or in your roads and railway networks. It's because the risk in Africa is still very high. So we see that infrastructure investors, from a private perspective, are still wary to invest in your long-term projects. We are hoping that this movement will change over the next few years, but that is where the regulators need to step in and start changing their business environment to get this funding into the market. And it's at a critical time. As I've mentioned earlier, your debt levels are increasing significantly in Africa. So we are needing that private sector investment to come in. So things need to change very quickly before we are in highly debt-distressed economies across most of the African continent. Just to also highlight your public and private investment, this is just a graph illustrating the number of projects happening in most of our countries in Africa. Again, the text is quite small, but I'll just highlight that Nigeria, Ethiopia, and Egypt are the largest recipients or the largest projects happening at the moment in those economies. Where you can see the blue bar is your public investment projects, and your private is the yellow bar. Countries like South Africa is also still seeing investment, but we're starting to drop down. It's because of the risk that is perceived is getting higher in Africa, or South Africa rather. And of course, us having the potential of being downgraded again by one of the ratings agencies. But essentially, this is again highlighting the problem we have. It's the public sector that is investing. And of course, we have to highlight the biggest problem across Africa at the moment, well, not at the moment, it's been for many years, is corruption. And that is affecting this investment going into these infrastructure projects. I just also want to lastly highlight, from an investment attractiveness perspective, what we've done with this graph is just highlight the previous graph that I showed you, number of projects happening in Africa at the moment from an infrastructure perspective, and we've plotted it on your y-axis against the RMB's investment attractiveness scoring, those top 20 that I showed you earlier. And we can see there's a very strong correlation between those countries that have very active and a large amount of investment into infrastructure projects, so a very strongly correlated, as I've highlighted, to where your most attractive investment destinations are lying. So I think the opportunities there for countries to at least bring them back into the top 10 or move up into your top 5 most attractive investment destinations is infrastructure development. So, ladies and gentlemen, that is Where to Invest in Africa, the publication in a nutshell. There's still many slides that I can show you and that we will have available for you after the breakfast presentation. But of course, we are also here to give you our views of what's happening in the Ghana economy. Specifically, I will highlight all your general macroeconomic indicators. I'll briefly focus on what we expect to happen with your growth rates, what we expect to happen with inflation and your interest rates. Naturally, we have to discuss the currency, but I think I came at a very good time when we've seen the currency come back nicely and strongly. And then, of course, Neville will end off with just highlighting what's happening in your capital markets, so your local and your hard currency bond market. So starting off with your normalizing GDP growth rate. Now, when we are talking about normalizing, what we are saying is that growth is just going to go from that high peak of 8.5% that we saw recently, normalizing back to around a 5% growth rate. So it's nothing to be concerned about. The reason why it is normalizing is that oil production that is normalizing. So we saw a very nice increase in your oil production, more than 50% increase in 2018, and expected about 30 to 40% increase in 2019. So that's boosted your growth rates quite significantly. As I mentioned, that will ease off to a very strong 5% growth rate. We can actually see that it is tracking above the sub-Saharan average of 4% growth. So still strong growth, but unfortunately, this growth is still driven by your extractive industry. So gold and oil will now be the largest, or has been the largest providers of GDP growth. And unfortunately, we are seeing that your non-oil or your non-extractive industries are still battling ever so slightly to boost that overall GDP growth rate. And the reason for this is, unfortunately, with the under-execution of CapEx or capital expenditure, basically due to the fact that the economy or that the government had to start consolidating fiscally, we have seen that affecting capital expenditure into the market. And that's been affecting the growth rates quite significantly. There's not enough money to be able to spend as much as the government would want to be able to boost the growth rates even more. There's also been poor asset quality in the banking sector, but we are seeing that changing now, especially after the recapitalization that Richard has been referring to. So we are expecting that your loan growth will expand again over the next few years, and private sector credit extension will also now be boosted. So we feel that that's going to play a big part in that 5% growth rate that we are expecting over the next few years. But it is these two sectors, gold and oil, that is still going to be your key drivers. And it's still doing relatively well. Specifically looking at your gold production on the left-hand side, we are starting to see that it's tracking up. And the reason for this is not only that we expect gold prices to increase ever so slightly in 2019, so that will boost your export revenues, but we are starting to see that your big mining companies, AngloGold Ashanti, Gold Fields for instance, have decided that they are going to increase the lifespan of their gold production, so that means they're going to invest more into their mining. That means they are investing more into the economy. So that's a positive. On the right-hand side, even though we are seeing crude oil production that will eventually start normalizing, it's just a normal thing to happen. We've seen it in most countries that produce oil. But unfortunately, that crude production is still very minimal compared to what we see other countries are producing, like your Angolas and Nigerias of Africa. But it will contribute to that foreign exchange earnings that we do need over the next few years to keep the currency at a relatively stable level. So at the moment, that's I won't say the saving grace for Ghana, but it is helping definitely keep that GDP growth rate propped up. Then I just want to highlight what our view is on inflation and rates, and with our esteemed panel members, we can also discuss that in further detail. Indeed, we are expecting February and March numbers. Well, we've seen February numbers coming in slightly higher than what we saw in January, but that is on the back of that weakness that we saw in the cedi, which is most likely going to filter through further into March. But thereafter, we will see the inflation rate stabilize again. With that, it's possible that it can head close to that 10%, but we do not expect it to go over the double digits. So this is still a positive. It means that we are still trending very close to your target band. That's that green section that you can see on the graph on the right-hand side. With that, we expect the policy rate to remain unchanged at 16%, something we can debate of whether it should have been dropped to 16%. And it's part of the reason why it's probably exacerbated the currency instability that we have seen over the past few weeks. But essentially, we cannot see inflation coming down significantly for the central bank to cut rates even further. And of course, we know that the central bank would also want to maintain an attractive rates for investors to come into the financial markets. So we believe that there won't be any change to this policy rate. There are even calls for them to reverse the 100% or the 100 basis points cut that we saw recently. I do think that will just send very confusing messages to the market, and it will just make it unstable or making concerns for investors of what is really going to happen in future from a monetary policy perspective. So for now, that's our view, 16% for probably most of the year. And then, of course, we feel that the FX supply and the stable utility prices will also support stable inflation over the next few months. So there's no big red flags that is flying in front of us from an inflation perspective. I think what we should be concerned about is your fiscal discipline over the next few years. This is probably Ghana's biggest test that we have seen in a very long time. And of course, we know it's because the IMF has now exited the market or is almost exiting the market. They did have a positive report on the latest review, which is great for sentiment. But of course, sentiment also needs to be backed by a track record. So the budget deficit, what we're expecting for 2019 is 4.5%. So it's very close to the 4.3% deficit that the government is expecting over the next few years. The reason for the increase is the government would want to invest more into infrastructure projects, which is a positive. My biggest problem is, will the revenue collection be able to manage that expectation? And we have seen that revenue collection came or underperformed in the 2018 budget. This is where we know that the government needs to work hard on that tax collection especially. That is where we also saw a bit of a drawback. So if we invest into changes like that, and if we also see that the government maintains that fiscal discipline of below 5% deficit over the next few years, I think that we will continue seeing investors coming into the market. They just want that certainty. So the positive also of the latest budget, the outdated earmarked funds as well as your unsustainable tax exemptions will be reviewed. I think that is the major positive. We just need to see that now happening. I want to highlight, though, the biggest concerns we have over the next few years. The fiscal adjustments definitely has been substantial, but it is definitely also reflecting, as I've mentioned earlier, in the capital expenditure of the government into the market. So we are going to see some missing targets because we are going to see some missing revenue targets as well. There's also been sizable fiscal slippages, as we all know, during election years. Some of our clients, specifically from London, are asking us what is really going to change in the next election to not have them overspend again. A very good question, which we cannot answer. The Ghanaian track record is of overspending during election time. And then, of course, you've got the extra concern of the extended credit facility of the IMF now coming to an end. So public debt is set to fall because of that fiscal consolidation. But unfortunately, we do not believe that it will go under 50% for at least the next 5 years. And 50% is quite a challenging number for any African country to be able to maintain. And I know Neville will also touch on how we are going to, how that's going to reflect in the debt market. The positive thing about the new fiscal rules is that we are seeing the government making the effort, especially when we see them putting that cap on a 5% deficit. But unfortunately, as I've mentioned, track record is very key for investors to come into African markets. So these new rules, we do not have a track record. We do not know if it is going to work. Even though it's positive, it's something that I do believe investors will look at as a wait-and-see process. And we will actually see that filtering into the market, where we would have seen strong investment coming into the market once the EM risk-on environment is back. But unfortunately, with that track record, we're going to see investors put a hold on significant investment into the market. I will end off, before I hand over to Neville, on the volatile cedi. You can see I've put that last, so I can quickly run through, because trying to forecast this currency at the moment is very difficult. Traditionally, the cedi is a depreciatory currency because the imports exceed your exports, so it's just a natural progression. And we see that in most of the African countries. And also with it being a managed float, we do not see this depreciation going out of hand. But obviously in recent weeks, we saw significant volatility in the cedi. There were different reasons, and we can go through them very briefly because I know you know your markets also very well, but it was seasonal. So we always see in January and February a significant weakness in the currency, mainly because importers are demanding goods or demanding dollars to pay off goods. And then, of course, we have also seen EM suffering a capital flight. So Ghana being one of your more of your EM, being one of the countries rather in West Africa, after Nigeria being a recipient of portfolio inflows, we have seen an outflow over the past few months, which has heightened that concern about investing into the continent. And then we've got, naturally, the rate cut that we've seen recently, and that has exacerbated the situation from the cedi volatility. So yes, we are starting to see some regulatory changes by the central bank, and they are just saying that it is not to curb what happened now, it is to potentially curb massive liquidity swings in the future. But it's something we're watching this space. We just need to get more clarification of some of the changes. So we are quite positive, and we felt that the currency will eventually come back. It does usually in a traditional way come back after a volatile January and February, but we also knew that there will most likely be a Eurobond issuance, that they will tap into the cocoa bod, that the IMF funding is going to come through. And then, of course, we saw a significant reversal in some of the losses because of that financial arrangement the central bank made to start replenishing the reserves. So we can see arguments for cedi stability, and we're keeping our year-end forecast at 520. We'll see how it goes. But the financing arrangement by the Bank of Ghana, with that, the IMF disbursement that just came through, or will be coming through after the review, of almost 200 million. You've now got a Eurobond of $3 billion. There's still a 300 million drawdown of the COCOBOT syndicated loan coming through. Then, of course, we are starting to see that your oil exports are increasing again, and it's expected to increase to about 180,000 barrels per day. Then we know that China's Sino Hydro drawdown could also be a debatable drawdown, but that we can leave for later discussion. And then, of course, we are going to see a restrictive budget and a positive trade balance. So all of these reasons are backing the reason why we think the currency is stable to come back and will probably end the year at 520. I'm also handing over now to Neville so that he can maybe just conclude the reason why we're expecting steady stability and how the financial markets and specifically the capital markets have been doing of late.
So I think Celeste made a mistake. We won't be concluding, because for the next 3 hours I'm going to be walking through the minutiae of the fixed income. No, I'm joking. We as economists are paid to talk, so that's part of what I'm getting paid for, so I have to talk a lot. No, but I'm joking. But I think the important thing over the last, I would say, a few weeks has been the relationship between the domestic fixed income market and what has been happening in the SEDI. And I think there's some insights in terms of the interplay between these two asset classes that we can possibly dive into. So what I've plotted for you on the top chart there is over the next couple of months, what portion of the interest that is due on the domestic bond markets, that is due to the offshore market, and what is due to the domestic bond market. Simply because of the reason between that the interplay between the offshore market and domestic is quite important in terms of the pressure that we see on the FX market. So if you typically have a large base of offshore investors that no longer feel that they are, it's a worthy investment to be invested in the domestic market, then that's going to put pressure on the FX market. And we've seen that over the last few weeks or so, where there were some issues around global emerging markets and whether that was a good play for investors, with dollar funding, who are typically invested in the Ghanaian market, whether it's a good investment or not. So we saw some pressure in terms of coupon payments that were possibly exiting, and we saw some of that feeding into the FX volatility that Celeste just explained. So that is quite important for us as we look at Ghana in the context of what is happening in the global EM space. Right now, we've got a fairly accommodative EM environment where people are starting to look for riskier assets, and that is good for us sitting here, simply because there is, appetite for offshore investors to be looking at Ghanaian assets again. But the problem with that is that sentiment tends to be extremely fickle. So in 1 week, you've got a risk-on environment. In the other week, you've got everyone that is pulling their money out. So a lot of that has to do with what is happening with the Federal Reserve and all the other major central banks. And part of that dynamic would tend to affect us simply because of the large offshore holding that we have in terms of the domestic fixed income market. And that brings me to the bottom slide there, where in the greater scheme of things, is Ghana really that bad in terms of how much offshore investors tend to own of the domestic markets? And what I've plotted for you there is you can see Ghana tends to play within the top quarter of broader emerging markets that usually fixed income investors tend to play in. And that is an important matrix for us to keep a hold of, simply because of if we see events in the global space starting to change, we can see some of that feeding through into our domestic FX market. So on a volatility basis, we tend to see that the rand, for example, is extremely volatile because there's a large offshore holding, and we're seeing some of that dynamic feed through into Ghana as well. So it's an important one to keep a hold of in terms of what the offshore investor base is doing insofar as their holding of domestic fixed income assets. So that leads me to what is happening from a Eurobond perspective, and I'm sure the papers here were littered in terms of what happened in the Eurobond roadshow that the ministers and the authorities recently came from, where there was a $3 billion Eurobond that was garnered from the offshore markets, and a large part of that is going to be used for maturing some of the shorter dated instruments. And what happened there, I think, is a function of several things. Number one, there are concerns around, what Ghana looks like, post IMF. And I think the sentiment, judging from some of the conversations that I've had with offshore investors, is that, there are some questions around whether we were going to see large fiscal indiscipline, or whether we're going to continue to see this fiscal prudence that we've seen over the last couple of years. And the answer in terms of where the market is at the moment is somewhere in the middle. So we might see, some fiscal slippage. I mean, we are going going to be entering an election period, but at the same time, there is a view that the lessons that have been learned under the IMF program will be carried through over the next few years. And that partly contributed to the large demand that we saw of these Eurobonds. At some point, there was the order book was 22 billion relative to the 3 billion that was ultimately issued. So there was huge appetite around that. But it's not all, for Ghana's credit. I think, like I mentioned earlier, there is some issues around what is happening from a global EM environment. And, with what the Fed has been saying in terms of some of its statements, has really played in the favor of frontier markets and emerging markets. And that played into some of the demands that we saw for the Ghana paper. And of course, we saw this was the first issuance out of Africa this year, so there was a real starvation of assets around Eurobonds. So this, really worked well in our favor. So I think the timing of that was particularly great in terms of ability to actually raise the amount of money they did at the price that they did. What I found particularly interesting is, as we went through, the final few hours of that particular issuance, normally you tend to see that, existing bonds tend to weaken simply because of the new supply that was coming through. But we saw the opposite in terms of what existing Ghana Eurobonds were doing leading up to the final issuance, and we saw that the price was actually appreciating, which shows that there was a huge appetite for Ghanaian paper. So I think there are some strong signs in terms of investors willing to give Ghana a second look in terms of what the ministry is doing and what the fiscal policies are going to be going forward. So that should be quite positive for us sitting here with a view in terms of what's happening from a fixed income space. So I think the interplay between the local fixed income market and the Eurobond market gives us a very good sense in terms of how offshores are looking at the developments that are happening here locally and the ability to actually raise funding at different prices. So I think so far it's thumbs up, and we hope that over the next few months and over the next few years we'll continue to see that fiscal discipline that would obviously work well in terms of ability to actually raise funding, which ultimately feeds into debt servicing costs and everything else that goes with the macroeconomic view. So that is my 2-minute spiel. I'm not going to give you the 3-hour version. At this point, I will ask our MC to come and introduce the panel going forward. Thank you very much.
Thank you very much, Neville, and we're not going to dwell too much. Let's get the experts here and get their thoughts. Ladies and gentlemen, help me welcome the Minister for Information, Mr. Kojo Oppong Nkrumah. And also Professor Peter Quartey from ISA to join the panel as well. I'd like to, at this point, I'd like to point out that if you have questions, you can go online to Slido, slido.com, and enter Ghana First in the meeting column, and that should take you to a page where you can submit all your questions, and then we can fill them and pass them on to the panelists to answer. We're live on Joy 99.7 FM, also live on the Joy News channel, which is broadcasting on the multi-TV platform, and also on DSTV channel 421 across Africa. And the hashtag to use is Ghana's Economy First. And also, for those of you who would like to tell the world where we are, we're also streaming live on myjoyonline.com, as well as on all platforms, YouTube, Facebook, and Periscope at First National Bank GH. So I'm going to dive straight into the questions. I'd like to start off with the Minister of Information, and this is not picking on you in any way at all, but I just would like to get your thoughts on whether there were any highlights from Neville and Celeste's presentation.
Yes, thank you, and good morning to Neville, Celeste, and to Prof, and to the audience here. No, I don't mind being picked on at all, but specifically, there were a number of things that I think come out quite strongly in the presentation. And the first is that this is more or less like a poll of polls, putting together what various other polls or various other reports say. And one of the things that comes from very strongly to me is that, yes, Ghana is reforming, but others like Rwanda, Kenya, Nigeria are making more significant reforms than we are doing. And what that says is that, for example, moving on, reforms must also be in very significant areas. If you look at the Nigerian detail, for example, the forex issue is one issue that is very significant within the body of reforms. And when you tackle that alone, it kind of has a way of pushing you further than others. So in terms of our reforms moving forward, we have to tackle some of the very significant issues. And I think as time goes on, we will have the opportunity to hit on a few of those. Our reforms also have to be benchmarked with what others are doing, or benchmarked to what others are doing. Else you can be of the view that you are reforming, but others will outpace you, and you might come out, slipping from 5 to 9, and it may look like you haven't done much. And so you need to benchmark as well. On the north side of the presentation, which deals with the economic activity, I think what comes out to me strongly is that we have to stimulate higher, broad-based, resilient growth. I mean, what has worked for us in the recent years, which is now going to normalize, can do with some more broader base. It's mostly in the oil and gas area, but what it means is that we also have to broaden it and make it more resilient and regular, so that in terms of the economic activity space, as compared to other jurisdictions, we don't lag behind that much. For me, those are the first things that hit me, in addition to the other opportunities, etc., that are available.
Okay, so we have about 30 minutes, so I'm just going to do a quick round with each of you, and then we'll all jump in and have one big conversation. I'm coming back to you again, Kojo. So we've dropped from 5 to 9. What plans do you think, or what actions would be required to, one, hopefully stop us from slipping out of the top 10, but more importantly, drive us further up the ranking?
Thanks. So like I said, it's in two broad sides. There's the economic activity side, and then there's the reform space. In the reform space, we have to tackle, as I hinted earlier, some of the more significant issues. You can have a list of 9 reform items, but depending on where they fit on the pain point of the business community, if they are not that significant, you won't very far. One of the things that we need to very quickly deal with is the issue of trade facilitation and the difficulties that are associated with trade facilitation. It has a way of translating even into prices for products that are imported, etc. And currently, government has been heavily engaged on improving the trade facilitation framework so that it is easier for people who want to do business, particularly on the international markets in and out, to find space so to do. Another thing that we have to very strongly tackle in the reform area is access to financing. And you were talking about, credit growth, and even on the equity sides, the availability of a pool of funds to fuel business. Again, like you mentioned, because of the fiscal indiscipline in recent years, which is now coming home to roost, you will find that, for example, in the financial services sector, which is what gives access to credit, you've had a constriction of it. You've had to literally do a bailout in the financial services sector, and you are now getting the financial services sector a bit more resilient to get credit back on its feet. And so what we need to do is to quicken our effort in the access to financing space, so that the private person who is requiring financing to fuel his growth in that area also has room to go. Very quickly, we also have to get a thumb on these stability indicators like inflation, currency, interest rates, and I'm happy to see that your forecast suggests that we don't have any major red flags in that area, although we would have wished to maybe even get it down a bit further. We're using 4.80 for the budget in terms of the currency. You are looking at 5.20. But I think generally we're talking about the fact that stability must remain so that it's easier for business people to do business. I think two quick things that we are looking to do is to ensure that government incentives for strategic growth poles are heightened. The areas of interest, low-hanging fruits, include infrastructure, like you mentioned, power, water, those areas. But the specific interventions that make it easier for the private sector to play in that space. If you're looking at about 3% of GDP from the government side into infrastructure, and the benchmark is 6%, the test here is what do you do to attract private capital to augment this 3% that you are putting in. So those government interventions for strategic growth posts, I think we have to be very quick at it. And finally, and tied to that, significant improvement in infrastructure, which supports business and other economic activity. These are, I think, about the 5 key areas that we are looking to focus on so that we can ace perhaps the next report that you put out.
Okay, thank you. I'm going to you, Professor Quartey. In 2018, quarter 4 to be precise, ISA did warn against excessive borrowing. And that's not the first time any such warning has gone to any government under the Fourth Republic. But borrowing is sometimes also quite justified. But clearly we haven't made the strides that we hope to make with the borrowing. So how do you see us sustainably continuing to borrow but grow?
Good morning, everyone, and thanks for inviting me. Debt itself is not a bad thing. It's not a bad thing to borrow, but how you use the money is what is very important. And to what extent are you able to finance the debt without causing much damage to your economy? Yes, we did warn against excessive borrowing, because if you look at the debt GDP ratios, it was in the 60s, were at a point hitting 70. I think at a point we had 73%. And if you look at the IMF assessments of, I reviewed the assessment reports of several countries, Ghana, Kenya, Cote d'Ivoire, and we were amongst the few that were red flagged. Looks like our debt levels were unsustainable, and we could see that having implications on how much revenue, how much expenditure in terms of we're able to make in terms of capital expenditure and in certain critical areas. So we needed to raise that red flag. As we continue to borrow, we are hurting certain parts of the economy, critical sectors of the economy, and I think we need to be wary of that. Then how efficient we use this money is very critical. It's not just borrowing for borrowing's sake, but to what extent are we able to track the funds and make sure that we get value for money in most of these expenditures? I think that's an area that we thought we needed to flag. One other thing we saw is that it's not just borrowing, but we were gradually having a lot of foreign denominated bonds, etc. And that has repercussions on your exchange rate. And I think the presenter mentioned about capital flight. The least noise or discontent, investors will move funds out. And that is one of the reasons why our exchange rate had this turbulence in that short period. So it is important to raise red flags against high debt or borrowing.
Okay. For those of you just tuning in to Joy 99.7, you're joining the 4th Economic Business Breakfast Forum, coming to you from the Mövenpick Ambassador Hotel here in Accra. And on the panel is the Minister for Information, Mr. Kojo-Oppong Nkrumah, and Director of the Economics Division at ISA, Professor Peter Quartey. Celeste Falconer is an analyst from RMB, as well as Mr. Neville, I'm going to take my time, Mandimika is our making up the panel. And you can join us with your own questions by going to slido.com, slido.com, and enter the code Ghana First, and you'll be able to submit a question so we can try and get some answers for you. That said, Prof, inflation was highlighted in the conversation. A number of factors were considered that if we were able to mitigate would help us stabilize inflation, which has a knock-on effect on the currency. But how much attention should we pay to inflation? How can it make or break our stride towards economic growth?
Inflation is a necessary good you need some level of inflation in your economy. So I don't think we should be so fixated on inflation that we want single-digit inflation, we want low inflation. Yes, some stable level of inflation is good. But I think going forward, and I think we've made this point, that we expect that as a country we should have an optimal level of inflation. We need to estimate that and know that this is the level of inflation that is not going to hurt jobs, that will ensure that, yes, you grow. Because there is a trade-off between inflation and employment. As government tries to cut down on spending, if you are not spending, you are not also helping to create jobs. So we need to strike a good balance between how much inflation you can contain to ensure that businesses are able to project and able to invest and make revenue. In the same way, you also have to have a cap on how much inflation you can contain. And I think there's been quite a few estimates. The IMF has some estimates that says anything in the range of, if my memory serves me right, between 15 to 18% for a developing country is acceptable. As a country, I think we need to estimate this optimal rate of inflation so that we know which figure we're actually working with. Okay. Thank you.
All right, just before we all join in and I start going to the questions coming via Slido, finally there was a key point about what the investor community would be looking out for, which is track record from Celeste's presentation. So we have some new great ideas on paper. We're now implementing some of them. The world would want to see how well that goes, but we're in a hurry. So how do we build track record in a hurry? It's as though a job advertisement says, you know, we want someone who is 5 years experience, but the people who really want it have just come out of school. We need to bridge that gap. How can we do that quickly?
Yes, we're in a hurry, but there are certain basic fundamentals that we need to get right. So for me, getting the macro economy or fundamentals stable is one of the key things that, and I believe government has been working quite well in achieving most of these macro targets. Nevertheless, there are quite a few things we need to do right. Access to credit is very critical for most businesses. The cost of credit itself is too high. If you have to borrow at 31%, 28%, what kind of business can you actually do and break even? I think that is quite critical. Okay. So we need to look at that. I'm quite excited. I was quite excited to see the index, how we compared with other countries in terms of infrastructure, in terms of all the key things, power and the rest. But I think it's not just the numbers. What about quality? I think, and that's a point I make to the editors of the report. If you're able to delve down into quality, we can have power. To what extent is it stable to ensure that businesses are able to use this to produce? I think that is very critical. But how can we move fast with this? One thing I find a bit lacking in our discourse is what is government doing? What are government policies? And I can refer you to the 10-point industrialization strategy. I always say there is a lot of rich information in there. I believe we should tease out what is in there. How do we implement these strategies? If they are well implemented, in my view, if we are able to achieve 60 to 70% of what is in there, and I'm sure Ghana will be a better place to live.
I like the silver lining in there. Mr. Ponkroma, I know you want to add a rejoinder, but before then, Celeste, did you anticipate Ghana slipping from 5 to 9? Let's see.
It helps when it's on. Yes, we did, unfortunately. But it was for two reasons, and the minister has alluded perfectly to the one, to say that other countries have been reforming faster than Ghana. Countries like the smaller countries in East Africa, like Rwanda, to your bigger economies like in Ethiopia, have been moving up the ranks specifically in its business environment rankings over the past few years. Rwanda being the fastest reformer, in fact, in the world when it comes to its business environment. So that's one of the reasons. But unfortunately, the other reason is that fiscal indiscipline that we have seen, unfortunately, and that has brought sentiment down. Not just sentiment, it actually physically showed in some of the surveys that tax collection, higher debt levels, the effects that it had on ratings agencies' views and reports on Ghana in the past 3 years, which has thankfully improved, but that has impacted the surveys that we use into the inputs.
Okay. So, Neville, the presentation indicated that one of the areas that we'll have to focus on in terms of navigating the challenges would be that we focus on technology infrastructure. If we hazard jump out of the box for a moment, technology and people is being touted as the next level of infrastructure. Can we start refocusing on that instead of the hard brick mortar and steel infrastructure that most of the countries in our grouping are focusing on?
Well, I think it's a combination of balancing the two, because you can't invest in your people, i.e. education, but you can't move the people from one part of the country to the other. So you need to take a two-pronged approach where you're obviously focusing on the transport, building bridges and everything else, but at the same time you're ensuring people mobility between countries. So in more developed countries, take South Korea for example, it's very easy to live in one part of the country and work in another part of the country. So I think those are some of the things that we need to look at. It's not an either-or situation. And we do see, countries like your East African economies, Kenya, for example, taking a very determined approach in terms of building the soft infrastructure, which we do focus on in the publication, but at the same time they're investing heavily in the hard infrastructure perspective. So I think there's some key lessons that we can learn here in Ghana as well in terms of obviously the enviable goals of reducing, unemployment, etc., but at the same time improving the hard infrastructure perspective, which would obviously kick us ahead in terms of the rankings that we just saw.
Okay. All right. So, Mr. Ponkrumah, you had rejoined, and then after which I will go on to our paperless portal for the questions coming in from our audience.
Not so much a rejoinder, just to agree with the two underlining issues that, one, we need to demonstrate a track record with the new initiatives that we are rolling out. Because the new initiatives like the Fiscal Responsibility Act, the Fiscal Advisory Council, the Financial Stability Council are the pegs that will hold down the cancer of fiscal indiscipline that got us here in the first place. But I think the message that I also like to take advantage of and send to the international investor community is that if there's anything that you can look to apart from these, it's also the immediate track record of Ghana as a state. I'm not even talking about the Akufo-Addo administration, but Ghana as a state in the immediate past years has demonstrated a certain level of fiscal discipline, which has enabled us come to this point, and which we are hoping to keep now with these pieces of legislation, etc., together. And even though, yes, we have an election year ahead of us, it is precisely to guard against our own tendencies that we have gone ahead to put, for example, even some of the sanctions that we've put in the Fiscal Responsibility Act. If the finance minister breaches that cap, he could lose his job. So we have tried to put, even upon ourselves, very hard constraints. And I think that a combination of the track record and the toughness of these constraints should signal the markets that we're hoping not to repeat our mistakes.
Okay, well, thanks very much. And for those of you listening and joining us via Facebook, this is the 4th Economic and Business Breakfast Forum brought to you by First National Bank, a truly digital bank. So we're asking you to go to slido.com and enter the code Ghana First and send your questions or comments. And I'm going straight to a few of them that have come through. Now, quite a number of them are anonymous. We'll read them all and try and get some answers. I'd like to start off with a question about exchange rate. It's been a topical conversation quite recently. Now, the question is simply this. 5 cedi 20 pesos or 4 cedis 80 pesos. Should I be worried as a business person? who'd like to go for this? I know the expert is here, but I'm sure we would like to hear from more from a government position on that one. So, Mr. Ponkrumah, that's yours.
My professor is here, so he'll have the final say. But very quickly, I think the exchange rate often is a matter of worry to all of us because it affects all of us. In addition to the issues that Celeste raised as the causes, one of the things that I think many people haven't noticed that really hit us is that at the same season when the cedi usually comes under pressure, Ghana now had, as a prior action to the exit, to build about $700 million in reserves. So at a time when the cedi is ordinarily under pressure and you expect the central bank to be able to assist, at that same time, we had now to be building reserves of about 700 million, and that contributed to the inability to, even do a short-term intervention. Thankfully, with all the flows and even the signaling of the market ahead, you've seen the activities of speculators go down drastically. The new market conduct rules are also ensuring that the kind of ease with which people contributed to demand is also tapered down. But the most important thing is that the medium to long-term underlying solution, which is boosting our balance of trade, boosting our balance of payment on a sustainable basis, and most importantly, in a diversified manner. Because, again, as she presented, if we're relying on commodities, and the broad view is that commodity markets, though gold and oil are fine, but commodity markets could take a tank in the medium term. If it's not broad-based on a regular basis, then we could find ourselves back in that situation. And I think that already you find with, for example, the agri programs like the Planting for Food and Jobs, the food import bill, at least for some specific items like corn, etc., are beginning to come down. We need to make it broader to rice in particular, etc. With the 1D, 1F program, we need to invest a bit more resources into it and tackle like machinery-related items that are a significant import bill to us. And as we succeed at those, what we are seeing can stabilize. But I'll let my prof tidy it up for me.
Over to you, Prof.
Yeah, thank you. I think the depreciation of the cedi depreciation is a cause of concern for businesses because most of our imports and even the duty they pay is tied to the exchange rate or to the foreign currency. So anytime there's a depreciation, they end up paying more, and the next time they're going to import, they need to spend more cedis or get more cedis to get the needed foreign currency. So that is a source of worry, and that affects food prices and prices of other commodities on the market. Now, the causes, I think we have several of them. We have short-term causes, and then we also have some of the long-term challenges. One area I think quite a number of the points have been raised earlier, but I think speculation is also something we need to guard against. And I have spoken to some of my friends in the media. Anytime we see some movements in the exchange rate, every second there's a discussion on the exchange rate. And there's that panic that we signal, we send out. I've met a couple of people who went to buy to hoard, basically because of this noise we feed to the system. And I think that is not helping us. Then also we have others who buy foreign currency. We have no track of any transaction in most even African countries, South Africa, Kenya, Senegal, you name them. Anytime you exchange foreign currency, you need to send an ID, they have to enter into the system. But that is not in our case. Now it's so easy, you make a phone call, somebody comes on a motorbike and gives you foreign currency. I have done it before, I must be honest with you. So easy, it's so easy to get dollars or pounds or whatever out of our country. So no matter how much Bank of Ghana pumps into the system, there is a leakage, there is a way out. People take it out easily. If we're able to monitor this and know where the demand pressure is coming, then we can fashion our policies to address them. Happily, yesterday, I stumbled into a circular, a directive from Bank of Ghana to all the forest bureaus and other financial institutions, directing them to keep records to ensure that the proper thing is done. To what extent do we follow us to enforce I am yet to hear from my minister whether that is being done. But I think, apart from the other factors we have heard, these are some of the gray areas we need to tighten and ensure that we're able to manage the exchange rate system. And I think earlier on I alluded to this 10-point industrialization strategy, as well as the planting for food and jobs. If you read them, a lot of brilliant ideas, but we have not achieved much with these two policies. Planting for food and jobs, yes, we've seen food production increase, and for some staples like rice, maize, and the rest, how much we produce is going up, and therefore we might not have to import so much. But we need to do more so that we rely more on locally produced items rather than imported items. Then lastly, we handle too much cash in our system. There's too much cash in circulation. We have seen that most of our traders go to China, to the Middle East. How many of them route it through the banking system? Very few. The majority carry the cash, though it's illegal, they still manage to take them out. So there is a lot of pressure on our exchange rate. I wonder why, for instance, we don't have a Chinese bank, for instance, who would ensure that those who go there can use the yuan Chinese currency to transact business. I'm told Nigeria has done it, where you don't need a dollar to go and trade in China. Why can't we do the same? Rather, we allow our traders to go through all of this and put so much pressure on our exchange rate. Thank you.
Thank you very much, Prof. I have a series of questions, and I think I'm just going to try and direct the ones that specifically mention you, in addition to two, which I think Mr. Nkrumah can handle. Now, we've just exited the IMF program. The question says, is the IMF really the solution to Ghana's problems? And I'd like to tie that into another question that says, Germany issued a 10-year bond at a yield to maturity of...
Some into being because expecting that different administrations will do, it has failed us about 13 different times. I think what now needs to happen is that as we exit and as we put in place at least some of the mechanisms I spoke about earlier, we need some consistency in delivery. And we need to explore also some creative ways by which predominantly we can finance some of our development needs without having to resort to the fiscal at every point in time. Because it is this unbridled desire to always resort to the fiscal when domestic resource is not up to the levels where it should be. That usually starts this exercise of overspending, deficits go up, debts are racked up, and all the issues that follow up. So broadly, we have clarity on what we need to do. Thankfully, we are out of this program, and now we have legislated some of the things into being. We just need to be consistent in delivering on it. And I go back to my earlier point that if what we've seen in the last 2.5 years in terms of discipline is anything to go by, we should be able to do a bit more of that moving forward.
Okay. The other question has to do with, and this is for you, Prof. In your view, what has been the impact of the rebasing and the additional borrowings on economic fundamentals centering on the CD? Sounds like an exam question.
It's like a two-in-one.
That's right.
Yes. I think the rebasing is good because for those of you who could remember, I couldn't imagine us if you want to carry 100,000 cedis, if you convert to the old currency. Those days where we had to move them in sacks, it wasn't convenient. A lot of the ATMs were breaking down because of pressure. And there were several other things. Yes, because of the rounding up of some of the figures, it led to some level of inflation. But I think the rebasing has been good for our economy, and I don't think we should run away from that. Now, the other question, rebasing, and there was the second one.
Yeah, the additional borrowings on economic fundamentals.
Yes, I think I did highlight or mention earlier. The additional borrowings have helped to some extent for some infrastructure projects that we've seen in this country. If we hadn't borrowed, I don't think we would have had them. One clear example is the Terminal 3, our airport, Terminal 3. It's a beautiful edifice that it shows what borrowing can do. You know, if you use the money judiciously. We've seen our N1 motorway. We've seen several other projects that's dotted around the country through borrowing. However, excessive borrowing can have repercussions on debt servicing. If you look at how much we pay, how much interest we pay annually, when you take out wages and salaries, then interest payments, statutory payments, national health and whatever, we are left with very little capital expenditure. So you employ people, but they have very little to work with. That is why we ought to be cautious in borrowing. We borrow to invest, but not to consume.
Okay, thank you. Back to you, Mr. Oponkrumah, and these are questions from our audience. This is in the face of declining monetary policy rate and foreign capital flight. How do you plan to harness the private sector to fill the gap? And then there's a second one. Are you ready for the second one? So the second question has to do with what can be done to improve the services at GIPC, Ghana Investment Promotion Center, who simply do not approve TSAs and believe in this as trade service agreements, as this discourages new investment. I hope I got the TSAs right. If I didn't, Mr. or Miss Anonymous, just correct me quickly via Slido.
So, very quickly, on the matter of
Okay. Well, that's buying me some time. It's transitional service agreements.
Very well. So, on the matter of borrowings, I think one of the elements that we have to force into the borrowing conversation, and I want to encourage my colleagues in the media so to do, is to also pay attention not just to the nominal figures, but to the rate of debt accumulation, the annual rate of debt accumulation. You would notice, for example, that from 2017 coming down. Indeed, if you compare the numbers from about 2014 going, and you look at the significant hikes in the rate of debt accumulation, that took us beyond a certain threshold. And if you look at the rate of debt accumulation, at least since 2017, you notice that gradually we are slowing down the rate of debt accumulation. It's like a vehicle descending a hill at top speed, because you have built a certain appetite in the country, and there are many services and even jobs that are paid through the fiscal. And if you've done a rate of debt accumulation that ensures that all of these people are on, you cannot necessarily in 1 year just cut it. Your vehicle will roll over. But you can slow it down gradually. And you notice that even though in nominal terms we may get a Eurobond of 3 billion, etc., if you look at the rate of debt accumulation, it's gradually coming down. The second thing I think we need to introduce into that conversation is a debt sustainability analysis. And very often you find people talking about the nominal figures, but don't look at the debt sustainability analysis. Like Prof mentioned, we should borrow to invest and not borrow for consumption. And if you borrow to invest, you see the output show up in your GDP growth for the year. And the debt sustainability analysis would show clearly, when you do the analysis, it will show clearly that, yes, your nominal has gone up, but, for example, your GDP has gone up way higher than that. Consequently, your debt-to-GDP ratio, as is now, is beginning to see a downward trend. So if you look at it in nominal terms only, you may run home with the argument that, the nominal figure has gone up. But I think that for those of you who engineer the public conversation, you should introduce these elements and help us get a balanced view of it. How do we help private sector to get more access to funding with all of the issues that you have spoken about? I think one of the things that central government needs to do is also to help the business community or the private sector attract funding to itself. Not all funding necessarily needs to come through the fiscal, because it has all sorts of implications. But at least if we tidy up and the ratings agencies are giving us some good ratings, etc., we tidy up the financial services market so that we have institutions here that can leverage on these developments and attract financing for private sector to pick, whether it's corresponding banking arrangements or whatever, for private sector to pick at some of these lower benchmark rates. I think that it will help ensure that we are moving, but not all of it is on the backbone of government with the necessary encumbrances that come with it. And then the last point, these TSAs that we talk about is not just the mere fact that because somebody wants to sign a TSA with government, the GIPC should just go ahead and sign it. There are some TSAs that are inimical to our national interest, and it is important that the GIPC, I know, for example, in one instance where over a year, you have a major superpower that has a standard agreement that they want to sign with.
Have we lost you?
I think it's important to realize that, offshore investments they are not inherently bad. I mean, of course, we're talking about in the context of a weakening currency. But I think what should be done is to realize that, the hot money or helicopter money or offshore investments are there to provide price discovery. Because they're in and out, they tend to be very fleeting in their nature. They allow for proper price discovery. And it also gives a feedback mechanism in terms of whether the policies that are being instituted domestically are viewed favorably or not offshore. What then needs to be done is to complement, with the domestic savings pool, whether it's pension funds, etc., to supplement that. So in instances where offshore investors are selling, by nature of a pension fund book, it tends to be very long-term and liability-driven, they can absorb some of that pressure. So I think it's a complementary effort. You can't sustainably run a domestic fixed income market by having 100% domestic investors, because you're never going to get that price discovery that you need. Neither can you run it by having 100% offshore, because it's going to be extremely volatile. So you need a balance between the two. As to what measures are being instituted, I think I'll leave that for the minister to articulate some of those measures. But purely from an outsider's perspective looking in, I think you need a balance between the two. And it's not, as I showed in my previous slides, having 30-40% offshore is not something that is unique to Ghana. But the question then becomes, what are we putting next to that in order to supplement the volatility that may come with a relatively high offshore investment?
Okay. Does anyone want to add something to that?
I think ultimately we have to make Ghanaians richer, because it's when more Ghanaians are richer, have more disposable income, that you can get a lot more Ghanaians taking up the CD-denominated bonds and, may I say, crowding out the offshore investors. And the way to do that is to ensure that Ghanaians hold the commanding heights of our economy, take advantage of the investment and growth opportunities, retain the profits, and then they can be the ones to buy in.
Okay. I think we'll take another round of maybe 2 or 3 questions. There seems to be a short-term chase for revenue on imports that is hurting importers. Doing costings after an import it's on an average of 115% duties and taxes. Mr. Pongroma, I'm coming to you for this one. And then I'll get Prof's thoughts on this. How much of this could be hurting the economy when the imports and the taxes, the revenue that's on there? Of course, you have to manage your revenue in order to bridge the gap between that and the expenditure. But at what point does it become an albatross around the neck of an importer, or at what point should it be optimal for us to achieve what we're looking for?
I think we all can admit that too much of our revenues come through the ports. And we don't have enough of it coming from direct taxes and other retail revenue options in this country. And as a first step, we need to focus on that. Number 2, even for the ports thrive on volumes. So when you have what appears to become a punitive import regime, where the taxes and etc. are also high, it becomes counterproductive. And that is why I think earlier I mentioned that trade facilitation is one of the very quick things that we need to be tackling. The economic management team and cabinet have done some work on it. I think on the 3rd of, and maybe let me do some ambush marketing, on the 3rd of April, the Vice President will be leading an economic management team town hall meeting, and he will have occasion to speak to some of the reforms that are immediately being introduced to make trade facilitation easier for our people.
Okay. Prof, did you want to add something?
Yes, I think the minister has said it all. We rely too much on import duties, especially at the ports, for most of our revenue. Why? Because we pay little direct taxes. Very few people pay direct taxes. So we keep taxing the same old people, and that is quite difficult. I was quite surprised to hear the number of people in Ashanti region, or Kumasi, to be precise, who pay income tax. It was quite shocking to hear that. And it's very clear, many people are within the informal sector. They don't pay taxes. Our artisans, on average, earn about 1,200, 1,500 a month, but they are not within the tax net. Whereas if you start earning from 300, 400, you start paying taxes if you are within the formal sector. So the way forward is to try and broaden the tax base by roping in most of these people in the informal sector. And I see the use of the tin and other means of knowing where people are, the kind of economic activity they are engaged in, and by so doing, you can rope them into the tax net. But that has to come with some benefit. They have to know or assess some benefits as well. It shouldn't be just taxing for tax sake. When they go to the hospital, there are no beds. When they go for facilities, they cannot access public service. I think the two have to go hand in hand. Then a quick point on the last discussion about the risk element. I would say for a long-term measure, we need to grow our revenue base. Because as for borrowing, getting investors, offshore investment, yes, that can come in, but that shouldn't be our long-term solution. The long-term solution is for us to grow our revenue base, and we'll need very little Eurobond and the rest to run our economy. Thank you.
Okay, thank you very much, Prof. So one final question that goes to every one of you. In the presentation, there was a clear upside in how the island states like Seychelles have harnessed a certain amount of infrastructure and targeting tourism to improve their position in the ranking. We have more than 460 kilometers of coastline, a very beautiful midland with a lot of green and a breathtaking savanna. What should we be doing if we want to grow on why have we not picked that as a low-hanging fruit? Or can we do so? What would it take? And in addition to this, you add your final words. I'm going to start off with you, Neville. Mr. Ponkroma, do you have the microphone? Okay. So we are down to...
Yeah, I certainly echo those sentiments insofar as boosting the tourism base. I mean, if you look at economies that you've just mentioned, a large proportion of what comes in as is FX, as it feeds into central bank FX numbers and subsequently supporting the currency. That is an important source of revenue, and there's certainly a lot more that can be done in Ghana to actually try and improve that. So I'll certainly say to whatever degree that we can, we must. As to the policies, I think I'll leave that to the minister to outline what exactly him and his team are doing.
Okay, thank you. Mr. Ponkroma.
I think we need stronger collaboration between state actors and the industry. You find industry players who, for example, want to sink 5, 10, 15 million into a particular tourism enclave, even if it's to develop it or to build a new one. But often the ancillary services that will now ensure that clients and markets get there, whether it's roads or helipads or the basic infrastructure as we spoke about, appears a bit delayed. And in terms of our general infrastructure development in this country, it follows a path that is not necessarily tied to the tourism sector. And so I think that a closer collaboration between what we are generally doing for infrastructure and the industry, so that we prioritize some of these areas, will help deepen activity in that space and activity in general. And while at that, I think that we also need significantly to promote domestic tourism. I mean, for all of these things that you talk about, we have at least about 20-something million Ghanaians who should be our first point of contact in patronizing and visiting these sites. And then on their back, you can expect foreign tourists to come in. And I'm hopeful that, again, as we promote a bit of that and deepen collaboration, we can do more. But in my closing remarks, I'll say that the road to economic recovery is often a long and difficult one. And if anything at all in recent years, as a country, collectively, we have demonstrated that we are back on that path and are beginning to walk that journey. What we need is consistency and discipline so that we can get to that destination in the shortest possible time.
Thank you very much. Professor Korte.
Yes, I think we need to market our tourist destinations. I don't think we've done to Ghanaians and also to the international community. I often feel embarrassed when on a flight to Ghana, you sit with a tourist and he or she starts asking you about certain tourist destinations in your country and you have no idea. It gets quite embarrassing. I think as Ghanaians, we should know the various tourist sites and try to assess them. Then, public-private partnership. I don't think government alone can provide the needed infrastructure in all of these tourist sites. It's impossible. Government should partner with the private sector.
Because you've got gold, you've got cocoa, you've got oil, so a lot of attention was given to those. But I think just to add to Professor's focus on PPPs, what we've noticed, and we live in this continent, every country in Africa is rather reactive than proactive in diversifying its economy. And what I mean by that is we as a continent are not looking forward as what does the world need from us in the future. And that's why I focused earlier a little bit on agriculture, I think, is the next best thing for Africa. So we just need to really get our infrastructure correct to focus on agro-processing. And the reason why I'm looking at this is because I've started reading studies of how global warming, how all these aspects are going to start affecting agricultural sectors in other countries. And Africa is one of the continents that still has the most arable land. We need to focus on those future prospects. Tourism, the same. We have seen that Asians and more from your Eastern Bloc European nations are now visiting African nations. And we need to take advantage of this new diverse spectre of investment or tourism coming into these economies. So we need to do the studies. The only way we can do these studies is by having skills transfers from the private sector and then seeing what Africa can do for the world over the next decade.
Thank you very much, ladies and gentlemen. Let's say a big thank you to Celeste Falconer, Neville Mann, Dimika, Professor Peter Korte, and Mr. Kojo Oppong-Nkrumah. You may please resume your seats and as we wrap up. Now, the presentation as well as the Invest in Africa report are available on the First National Bank website. But if you don't want to stick within the digital bounds and would like a hard copy, speak to your relationship manager. And if you don't have a relationship with anyone at First National Bank, today is a good time to kick off with a new relationship. We're coming to the end of this morning's Economic and Business Breakfast Forum. And with that, help me welcome the head of Commercial, Corporate and Investment Banking at FNB, Mr. Victor Yawasanti.
Thank you very much. Well, Kenyan balance, all too soon we have come to an end. Thank you very much, all of you, for coming. We started this journey about a month ago when I think Delali and I started engaging the media. It wasn't a particularly good time because everybody was concerned about the city. We tried to put some articles out there, and it caused quite a bit of a stir where we had to keep explaining. So when I say thank you to Celeste and I say thank you to Neville, I say thank you also because of the work we did previously leading to today, because each time we put our thoughts together, we had to come to you to make sure we're saying the right things. And there is a reason why RMB is rated as one of the best research houses in Africa. And I hope that you connect with us even beyond today so that you can get some of the insights that we get. The number they give us is 5.2. I know a lot of people always end up asking you, so where would the dollar end when the year ends? The number is 5.2. Let's work with it. Thank you very much for coming all the way from South Africa, my colleagues Celeste and Neville. Thank you. Of course, Mr. Minister, I asked you to stay slightly longer. Today, I found economists in you. I know you're focused on law these days, but you have to go back to some of your fundamentals to try and speak to us. This wasn't a conclave meeting. We used to have it. I know you're busy lately. We'll do it a bit more. Thanks for coming. I know you want to go because today is when we pass the Rights Information Bill, and you must be in Parliament. And we appreciate very much that you didn't cancel. For a moment, we're worried that you'll be pulled in because this is your bill. We appreciate you, and please let's see you a bit more. Thank you for coming. Prof. Where's Prof? I hope there's no bike waiting for him for some dollars. Has he gone? So, Prof, please, next time when you need the dollars, please call us. We are here to help you. We are First National Bank. We have quite a bit of it, and we'll give you a good rate. Don't worry about that. And please take the message, everybody. Make sure when you need your dollars, just call us. We are here to help you as our strap line says. Thank you very much, clients. We behaved well. Ghanaian time was slightly better today. We came at 8:30, and at least most of us did. We're happy we did. Next year will be bigger and better. We'll continue to give you the information you need so that you continue to be on your exit because we are as good as you are as our business partners, and we are always happy to host you. Thank you so much. This year has been the year of the city, even though we thought it was going to be the year of the infrastructure. But the city first, and then we can talk about infrastructure. Thanks for coming, and see you soon. Thank you.
And from me, I'd like to say thank you all for coming. It's been a worthwhile learning experience. Again, if you need to download the presentations, go to firstnationalbank.com.gh and you should be able to get all of that there. But if you need any more information beyond that, the members of the FNB team are around. Engage them and they'll mostly be happy to help you. We'll see you again next time. God bless you all. I'm Inshirado. Thank you.
you.